Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Mastering Value Investing, Warren Buffett's timeless strategy explained. Value investing offers a straightforward approach to growing wealth. At its core, it involves buying undervalued stocks and holding onto them until their true worth emerges. Warren Buffett is a central figure in this investment strategy, known for his wisdom and success over decades. His methods focus on understanding a company's fundamentals rather than chasing market trends. In today's unpredictable market, Buffett's principles remain relevant. They can guide both novice and seasoned investors in making informed decisions. This video will break down his strategies and show how you can apply them to your investment journey. Ready to learn how to invest wisely? Understanding value investing. Value investing is an investment strategy centered on purchasing stocks that are deemed undervalued relative to their intrinsic worth. The aim is to identify companies whose stock prices do not reflect their true potential for long-term growth. This approach relies on thorough analysis and a keen understanding of a company's fundamentals, such as earnings, dividends, and sales growth. Rather than chasing every market trend, value investors look for bargains that the market has overlooked. What is value investing? At its core, value investing involves buying stocks that are available at lower prices than their actual value. Imagine a high-quality item on sale. Just because the price is low doesn't mean the item is worthless. It often means it hasn't drawn the attention it deserves. For instance, let's say there's a well-established company that consistently generates profits but has been affected by temporary issues, driving its stock price down. Value investors would see this as an opportunity, believing that in time, the stock will reclaim its rightful value as the company rebounds. This strategy isn't about quick flips or short-term gains. Instead, it requires patience and conviction, allowing investors to hold onto their shares until the market recognizes the company's worth. Emphasizing a long-term outlook, value investing can be a path to financial stability for those willing to do the necessary research and wait for their investments to mature. Historical context of value investing. Value investing has a rich history that predates Warren Buffett. Benjamin Graham, often called the father of value investing, laid the groundwork in the 1930s with his book, The Intelligent Investor. He introduced concepts like intrinsic value and margin of safety, which are fundamental to the strategy today. Graham's teachings influenced others, including his students, such as Buffett, who took these principles to new heights. Alongside Graham, other notable figures contributed to shaping value investing. Philip Fisher emphasized investing in quality growth companies, highlighting that great companies often lead to great investments. This combination of Graham's focus on undervalued stocks and Fisher's emphasis on quality provided a balanced approach that many investors still follow. Key principles of value investing. Understanding the main principles of value investing can help you make smarter investment choices. Here are some crucial concepts. Intrinsic value. This represents the true worth of a company based on its fundamentals, such as earnings, dividends, and growth rates. Value investors seek to identify stocks trading below this intrinsic value, offering potential for appreciation. Margin of safety. This principle acts as a buffer against errors in analysis. By buying stocks at a discount to their intrinsic value, investors can reduce the risk of losing money. Think of it as a financial cushion that helps protect your investments from market volatility. Long-term focus. Value investing isn't about quick wins. It emphasizes patience and a long-term mindset. Investors are encouraged to hold onto their stocks until the market realizes their true value, which can sometimes take years. By grasping these key principles, you can develop a solid framework for successful investing, one that mirrors the strategies of legendary investors like Warren Buffett. Embracing value investing can lead to wealth accumulation, but it requires discipline and a commitment to research and analysis. Warren Buffett, the value investor. Warren Buffett is more than just a name in the investment world. He is a symbol of the value investing philosophy. Understanding his background, influences, and the strategies he applied can inspire anyone looking to invest wisely. Let's take a closer look at his early life, introduction to investing, and how he transformed Berkshire Hathaway. Early life and influence. Warren Buffett was born on August 30, 1930, in Omaha, Nebraska. His early exposure to business came from his father, Howard Buffett, who was a stockbroker and a member of Congress. This environment sparked Buffett's interest in investing from a young age. He would often accompany his father to the office, soaking in the lessons of the stock market. Buffett's fascination with numbers and business started early. At just 6 years old, he bought his first stock, City Service Preferred, using money he earned from selling chewing gum and soda. This fundamental interest in the market was nurtured by his family. His mother, Layla, was supportive and encouraged his entrepreneurial spirit. Over time, he absorbed valuable lessons about hard work and responsibility, shaping his investment philosophy. Reading played a significant role in Buffett's education as well. He was heavily influenced by Benjamin Graham's book, The Intelligent Investor. Graham's principles on intrinsic value and margin of safety resonated with Buffett, laying the groundwork for his future investment strategies. This blend of early exposure to business, supportive family influences, and foundational reading propelled Buffett into the world of investing. Buffett's introduction to investing. Buffett's formal journey into investing began when he enrolled at the University of Nebraska. After completing his degree, he went on to study at Columbia Business School under Benjamin Graham. His education deepened his understanding of value investing, focusing on buying undervalued stocks. Buffett adopted key principles during this period, emphasizing the importance of thorough research and patience. After graduating in 1951, Buffett worked for Graham's investment partnership. He quickly learned the ropes, observing how Graham analyzed companies. One essential lesson was to look for businesses with strong fundamentals but low stock prices. Buffett took this to heart, applying it to his early investments. In the 1950s, Buffett launched his own investment partnership. He created a strategy based on finding stocks that could deliver consistent returns without excessive risk. He focused on companies with solid financials and a durable competitive advantage. This approach amplified his success, allowing him to establish a reputable presence in investing circles. Berkshire Hathaway, a case study. In 1965, Buffett took control of Berkshire Hathaway, a struggling textile manufacturing company. Most investors would have seen it as a failed venture, but Buffett had a vision. He recognized the potential to leverage this company as an investment vehicle, shifting its focus from textiles to investments. Buffett's strategy for Berkshire was rooted in value investing. Rather than trying to revive the textile business, he began investing in other companies, employing the techniques he honed over the years. By analyzing companies meticulously, he sought out those with strong fundamentals that were undervalued by the market. Over the years, Berkshire Hathaway transformed into a diverse holding company. Buffett invested in various industries, including insurance, utilities, and consumer goods. Notable acquisitions included Geico, Coca-Cola, and even the food giant Kraft Heinz. Under his leadership, the company thrived, demonstrating the effectiveness of value investing principles. Berkshire Hathaway's success illustrates Buffett's commitment to long-term value creation. He often emphasized that time in the market beats timing the market. His patience and careful selection of investments paid off, turning Berkshire into one of the most formidable investment conglomerates in the world. Warren Buffett has shown that with the right principles and a commitment to understanding the market, anyone can become a successful investor. His journey provides a roadmap for both new and experienced investors looking to harness the power of value investing. Buffett's investment strategy. Warren Buffett's investment strategy is a blend of careful analysis, patience, and an eye for value. His approach stands out in a world filled with quick trades and market speculation. Understanding how Buffett navigates the investing landscape can provide valuable insights for anyone looking to build long-lasting wealth. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.